Imagine being involved in a company or a product that's truly going to change the world and people's lives for the better. And saying you were involved with that company at the very beginning when nobody knew who we were. Nobody knew who SPRiZZi was. You can be involved with SPRiZZi today.
As an investor, are you more inclined to invest in a publicly traded company or a private company? There has been an incredible trend over the past decade that many savvy investors have kept close to their vest while reaping huge profits. That trend is that of investing in private company stocks. The very term private equity continues to evoke admiration, envy, and in the hearts of many public company CEOs, fear. In recent years, investors in private companies have pocketed huge sums stocking ever larger acquisition targets. The global value of private equity buyouts bigger than $1 billion grew from $28 billion in 2000 to a staggering $319 billion in 2016, according to Dealogic, a firm that tracks acquisitions. And today's biggest returns are going to early investors in private companies, especially high-growth technology companies that are changing nearly every aspect of life. Rather than wait for a company to go public, often at a high price, investors are buying stakes in private startup companies for as little as $10,000. This graph shows how the days of seeing 600% returns in public technology companies are largely over, with such opportunities confined to private investments. So what does this trend mean for you as an investor? In order to gain greater returns, you should invest in private companies with huge upside potential. Well, that's easier said than done, as many of these diamond-in-the-rough smaller private companies are gobbled up long before the word gets out to the smaller angel investor. Well, today is your lucky day. One of the companies that is on the verge of a major market breakout is a small California company making major strides in changing the face of the multi-billion-dollar beverage industry. This company is the SPRiZZi Drink Company. For years, this multi-billion-dollar beverage industry has largely been dominated by two players, Coke and Pepsi, banking huge profits and gains for well over 100 years.
When you look at the 2015 to 2020 period, all the data, all the research shows that non-alcoholic beverages, Sarah, are going to be growing by $300 billion. Consumers are going to spend $300 billion more to buy non-alcoholic beverages of their choices. Of that $300 billion, $100 billion will come from sparkling beverages. So what we see here is a tremendous growth opportunity in revenue and in value.
In the 1980s, the industry underwent a major upgrade, which further increased these two giants' profits, further distancing themselves from any other beverage company's ability to compete. That change was the invention of post-mix dispensing in restaurants, bars, stadiums, and convenience stores. The fact that a typical 12-ounce soft drink carries 84% water, the beverage giants recognized the need for post-mix dispensing to go further now and to find its way into offices, homes, and anywhere water can be provided at the source.
And I think, if you just say one more thing, in the next 10 to 15 years, Sarah, beverage brands in the world are going to be built and enhanced in three ways. One is ready to drink, continue to be in packages like this. The second is at home through technology like Keurig Green Mountain Cold, the pods. And the third is technology enhanced occasions, again, at food service like Freestyle. And think of that as a triangle. And to the extent that we can move between each end of that triangle fast, from home to ready to drink, from ready to drink to food service, from food service to home, right, that will be the determinant of success.
Both Coke and Pepsi validated this by investing huge money into the development of single-serve post-mix technology. Coke invested $2.4 billion into a Keurig cold system only to fail due to the imperfect technology and marketing approach. And Pepsi invested millions into a European company called BevEase, which was later bought out by Coke and Keurig for $220 million to clear the path for the Keurig cold technology, which subsequently failed and was scrapped after 10 months on the market.
Why not just buy the full company?
Well, I mean, I've always said it's the best way to benefit from that partnership. Coca-Cola is about power of partnerships. That's the best way to describe the Coca-Cola system around the world. Power of partnerships with our bottling partners, with all our retail partners, and with great technology partners like Keurig, Green Mountain, or an energy partner like Monster.
After these two failed attempts, experts suspect the two beverage giants are now waiting for a smaller technology-driven company to develop this segment before re-entering the single-serve category. SPRiZZi is that company. For 5 years, SPRiZZi has been developing and perfecting this technology, and it far surpasses all specifications of that of the failed Keurig cold technology. SPRiZZi's tiny and attractive countertop dispenser can dispense any post-mix beverage, carbonated or non-carbonated, from any beverage manufacturer, and also has a complete line of their own amazingly all-natural beverage flavors. SPRiZZi's go-to-market strategy is exactly the same as Keurig used when launching the single-serve coffee technology in 2000. To grab market share while building a strong name and brand before introducing a more economical version to residential customers 3 years later. And to further increase their company's valuation, they opened up the K-Cup to the likes of Starbucks, Dunkin' Donuts, and many other well-known brands. SPRiZZi will use a similar approach. By year's end 2017, SPRiZZi expects to have revenues exceeding $12 million and units in at least 1,000 offices throughout the United States, generating a minimum of $500,000 per month in residual flavor sales. Over the next 6 months, SPRiZZi will be raising $30 million in 4 fundraising tranches, with each tranche growing in valuation and returns. The first tranche is already underway and will raise $1.5 million to allow SPRiZZi to improve the automation processes in its incubator manufacturing plant in Southern California, while also adding speed and automation to its bullet filling and labeling production lines. A portion of that will also go to sales and marketing of the first 500 dispensers, which will be corporately owned and placed in offices throughout Southern California by SPRiZZi's marketing street team. The shares for this tranche will be sold in minimum blocks of 12,500 shares at $2.11 per share. The second round of funding will be for $4.5 million and will be used to continue sales and marketing efforts and to begin the transition of manufacturing fully in China with one of SPRiZZi's already selected manufacturers. The goal is to have full manufacturing done in China by Q4 2017, which much of the groundwork has already been laid. The share price of this tranche will yield a $4.18 price per share at a valuation of $42.5 million. This price should be very easy to justify, as the sales and manufacturing engines will be in full swing, with many goals and milestones and metrics being achieved. The third tranche will raise $9 million and will allow SPRiZZi to begin utilizing its global partners in Asia, Europe, and Canada to begin global expansion. With orders already in from the Middle East, Germany, and Canada, this segment of SPRiZZi's expansion will catapult the company's valuation and appeal to acquisition seekers around the world. SPRiZZi also has signed agreements for nearly $1 million from several water companies to begin selling its product across the country once SPRiZZi finishes laying its corporate sales foundation. These shares are being estimated at $8.67. The final tranche will be for $15 million and will be largely for SPRiZZi to offer dealer financing, giving SPRiZZi the ability to expand its dealer network more rapidly and reaping the financing interest while doing so. The shares for this tranche will be sold at $15.87, and once completed, the share price for the company is estimated to be approximately $24.56. That is a 12 times increase from the first tranche. SPRiZZi's CEO, Michael Breaux, expects a 12 to 24-month acquisition offer and will begin entertaining prices at $600 million as early as 12 months in, depending on the company's milestones, and up to $1.5 billion starting at the 18-month threshold. Those numbers could yield an early investor an amazing 30 to 75 times on their investment. That's the beauty of getting in early and finding a private company with this kind of potential. Even an investment in the fourth tranche could yield a healthy 7 times return. If you or anyone you know would like to invest in this amazing diamond in the rough company, call 844-4SPRiZZi to speak directly with the company's CEO. SPRiZZi, this is one you're not going to want to miss.
Come join us at SPRiZZi and help us make a difference.
When a star is born, they possess a gift or two. One of them.
On Saturday, the SPRiZZi team hit the road for more personal deliveries.
To make a wish come true. When you wish
It was quite a magical day for Alan Cohen and his son Alex as their delivery came just ahead of special Father's Day weekend plans. Hey Cohen family, you just got your SPRiZZi drink machine. Now what are you gonna do?
We're going to Disneyland!